Alibaba stock recently hit an all-time low back in October, but has been on a steady increase ever since. But even today, it's still dirt cheap by any metric. So why is this? And makes this Alibaba a stock you can buy without thinking? Let's find out. Now, for those of you who don't know Alibaba, here's a quick rundown on what they do. Most of you know them from their e-commerce site. Now, a lot of people compare Alibaba, their e-commerce site, to Amazon, stating it's the Amazon of China. Alibaba is more the eBay of China. Alibaba is a marketplace where it connects buyers to sellers. It doesn't buy and then resells its own inventory or own a vast logistic network like Amazon. It's more like eBay. You are right when you first think of the Chinese commerce retail side when thinking of Alibaba. 66% of its revenue is China commerce retail and 5% of its revenue is from international commerce retail. Besides this being the biggest revenue stream for Alibaba, they also have their cloud computing business, which accounts for 10% of their revenue, with the rest of its revenue coming from logistics services, wholesale sales, digital media and entertainment, and innovation or others. For now, we will focus on the two largest pillars of their revenue, retail commerce and cloud computing. When we have a look at the figures from the last quarter, we see a slow growth for those two pillars year over year. Chinese commerce was down 1%, international only up 4%, and cloud was also up only 4%. However, their EBITDA numbers look a lot stronger. This shows us that this company is run very well. They also have a cash or cash equivalents of $68 billion, so a real strong balance sheet for this company, with their cash reserves increasing year over year. They did stock repurchases that quarter alone of $2 billion. They also announced that they already repurchased $18 billion of shares under their existing $25 billion share repurchasing program. In addition, they approved the increase of that repurchasing program by another $15 billion and extend the program to the end of March 2025, making this repurchase program a $40 billion behemoth. No wonder Charlie Munger is excited about Alibaba. Speaking of which,
China is uninvestable, in my opinion, at this point. Why is that? I don't trust the data. I don't trust the relationship between the United States and China anymore. I think that investments in China could be confiscated. I think there's a risk of that, end quote. Obviously, with a significant percentage of the Daily Journal's marketable securities invested in BYD and Alibaba, you feel differently. Please explain why you are right.
Well, of course, only the future knows who's going to be right. But China is a big modern nation. It's got this huge population and this huge modernity that's come in the last 30 years. We invested some money in China because we could get more value in terms of the strength of the enterprise and the price of the security than we could get in the United States. When you buy Alibaba, you do get a sort of a derivative, but assuming there's a reasonable honor among civilized nations, that risk doesn't seem all that big to me.
Why would anyone as smart as Munger or Buffett consider investing in China or any of the Chinese companies?
Well, we did it for a very simple reason. We got more strength per dollar invested. In China, the companies we invest in are stronger relative to their competition and priced lower. That's why we're in China.
Why doesn't Buffett buy Alibaba?
Warren, like many other intelligent people, likes to invest where he's personally comfortable. And for some reason, I'm more comfortable with the Chinese than he is.
it must be noted that Charlie had at its top over 600,000 of shares of Alibaba, but he has sold half of them in the beginning of this year, so he now has 300,000 of them. What this means, only Charlie knows, but you can make your own assumptions about this. I think he just wanted less exposure to China than he originally had in mind, with the latest news on government policies. Now back to the numbers. As we can see here, these are all in Chinese currency by the way, the revenue has gone up dramatically over the years, and it really shows no signs of slowing down. They are also more than profitable when we look at this from a yearly basis, but we already knew this since they are repurchasing stocks at a great pace. Now, is this company interesting to buy? Well, it would seem so. At a market cap of $233 billion, it has a forward PE of 9, which if we would compare this to Amazon, since Amazon also has an e-commerce and cloud computing side, the forward PE of Amazon is around 42. If we also factor in their stock repurchasing program, and if we look at the stock charts, where we see we are trading at near all-time low levels, I could only recommend into buying this stock. However, there is one major concern that keeps me from saying this to you, and you can find out more about this here.